I want to just kind of preface this by saying I am a long-term investor. And so for people that are trying to get in and out of the market and trying to time it, I've never been successful at it. And generally speaking, the people that have been the most successful that I've ever seen, they generally have got lucky. I'll use the word lucky on a couple of projects, right? And they have big wins, and people think, wow, they're so smart. But the reality is they were just in the game the entire time. So they were in the game of real estate investing for 30 years. And because they were in the game and they owned a property and they happened to, a tenant was renewing and they were able to double the rates, all of a sudden their property went from 5 million to 10 million or something to that effect, right? But it wasn't because they were and they'll admit this, it wasn't because they were either lucky or smart. It was just because they were in the game and the market moved in their favor and they weren't trying to quote unquote time the market. So I think that that's a fallacy that a lot of investors fall into, myself included, when I first got into commercial real estate, was that you could time the market, that you would get in and out, and almost like day trading. And real estate, just by its very nature, it can take 90 days, 6 months, a year to sell a property in some cases. And a lot can happen in a year. A lot can happen in 6 months. So I'm going to kind of give you three perspectives that I have and tactics, and then maybe it will guide how you're looking at investing in commercial real estate specifically. Okay, so the first is that what I'm seeing more and more of is more sellers than buyers. And so if you think back a year ago, 3 years ago, 5 years ago, there was this. I was talking about the pendulum, and there was a major imbalance where there was a lot more capital, a lot more buyers chasing very few deals. And so it wasn't uncommon to see 20, 30 people bidding on one property. And what happens then is that the prices just keep going up and up, cap rates get compressed, returns get squeezed, and that was the world we lived in, right? And so it was very difficult to find good quality assets that you could properly assess the risk on. At least that was my experience. And that's really what led me to doing a lot of developments. Today, especially in the Calgary Real Estate Forum was just last week, and I had a lot of I had some good conversations with investors, lenders, brokers, and they're sharing very similar thoughts, and that is there's not many buyers in the market right now. And so if you are a buyer and you are looking at assets, you have a lot more power in the negotiation. So that's going to lead to my very last point here in a second. But so the first one is the market is moving to a buyer's market. And I think that that's a good thing if you are a long-term buyer. Okay, so that's number one. Number two is interest rates. And I have no idea where they're going to go. I think for the foreseeable future, they're going to continue to rise. And as of today, I'll date stamp this, October 26th, I just saw that the Bank of Canada raised rates by 50 basis points. Now, it was expected by many analysts that it was going to go up by 75 basis points or 0.75%. So what happened is the bond traders, because that's how commercial debt is typically priced, they anticipated a 75 basis point increase, but because it was only 50 basis points, bonds have come down. So how do you kind of interpret this, and how do you plan accordingly, if you will? Well, once again, I'm just going to come back to this theme of being a long-term investor. We had one of our projects that we were just refinancing, and it's a townhouse development, and we secured 10-year money at just below 4.5%. And bonds, when we started this process about 3 weeks ago, were closer to 4%. And so we thought, we're going to have this money in 15 to 20 days. We've got lots of room because the ceiling rate that the lender had given us was 4.5%, meaning if it goes above 4.5%, we're not going to get as much money. Well, I think it was Monday of this week, our broker called and said, look, you have to it was either, no, it was Monday last week. And they said, look, you got to get this thing locked up because bonds are jumping around by 20 and 30 basis points. And you are like 5 basis points away from being offside. And so we ended up having to secure it as quickly as possible. Now, in hindsight, knowing what happened today, looking back, it would have been prudent to wait, but no one knows what's going to happen. And so I don't beat myself up. I don't think about, oh, I should have waited, because if the Bank of Canada would have raised it by 75 basis points, it's reasonable to expect that our interest rate would have exceeded 4.5%, and then we would have obtained less money. So it's just very challenging to try to time the market. I know I'm certainly not smart enough to know what's going to happen and where things are going to shake out. So I'm not even trying to play that game, right? As long as the interest rates make sense, as long as the deal makes sense today, then I'm going to proceed based on the type of underwriting that I'm doing, okay? And this kind of leads into the very last thought or strategy that I'm using, and that is we're not doing any market deals. And so what does a market deal mean? A market deal is essentially kind of like what brokers, or maybe the best way to describe it would be to say like a seller that could have sold his property 3 months ago or 6 months ago or whatever that number was at the prevailing cap rates. To me, that no longer is enticing enough for me, right? For some people, it still works. I'm just saying for my own purposes, in order to, even just to raise the money, right, from my investors and give them a compelling reason as to why we're going to buy in potentially a declining market, it has to be a compelling reason. Below replacement, right? And so I'm not going to get into that because it would be an entirely different podcast. But below replacement costs, I know that construction costs have continued to rise. And so I'll just touch on this real quick. I see, if you're looking to build, and we're seeing this as a builder ourselves, that prices are continuing to increase, right? And so buying below replacement, I think, is going to be an easy strategy, if you will, because the costs just continue to run. Buying under market rents, maybe finding just an irreplaceable or amazing location, like an A center ice location. And that's going to be different in every market. It's going to be different for different asset classes. But if you're in the game, you should really be able to identify like this is an A location. And then obviously the last one would be just having like strong demand, meaning more tenant demand than supply. So those are kind of the things that I'm looking at. So just in summary, number one, I'm taking a very long-term perspective. Number two, I'm looking at this being a buyer's market, meaning that there is fewer buyers and more sellers, which means that I have more power. If I'm a buyer, if I'm a seller, then the opposite is true. And so I am on both sides of that equation. I'll just kind of put that out there. So, don't take advantage of people, because especially if you're playing the long-term game, you realize that things move back and forth, right? So just take that into consideration. And then with interest rates, not knowing where they're going to be, I'm just really looking at, as long as the interest rates make sense today, I'm not trying to play the bond market. I'm not trying to predict what's going to happen next week, next month, next year. We're basing it off of, okay, this is where it's at today. It's highly likely that the bank is going to increase rates again, another 50 basis points or whatever it happens to be, and whatever that date is going to be. And so we bake that into our assumptions based on whenever we're looking at purchasing. And as long as the numbers make sense, then, we proceed on that basis, or we don't. So anyways, that was a bit of a ramble, but I am getting a lot of questions on it. It's less about, I think, having the right answers as it is on what is your belief and your philosophy on where things are going to be. If you really believe that the market is going to continue to deteriorate, then it may make sense to just press pause and wait, right? Personally, I like these times. This is when I think this is when the greatest opportunities come, when there's tremendous uncertainty and very few buyers, right? Because that really kind of lends into people that are trying to acquire, right? I think it's unrealistic to think that you're going to time the very bottom of the market. And so that's why we're just kind of looking at it saying, look, as long as we buy prudently today, we can last when this market kind of corrects, and then when we come back up the other side. So that's all I've got. I got to run. Have a great week. Bye for now.